Good evening, good morning, good afternoon, wherever you're listening or watching us from. Today, the 5th of March 2025, you're welcome to Stocker Team, the Investors Channel. Just before we get into the business of the day, every information, just as a disclaimer, every information shared on this channel is for education and information purpose only. So speak to your financial advisor or do your due diligence before taking any decision. And on that note, thank you so much for being part of this channel. Thank you for subscribing. Thank you for following us and also sharing our videos and also sharing your feedback to us offline and online on this platform. Also, please join our community on X if you haven't. That's where we bring you all the breaking news that moves the market and also your investment portfolio. So today, I'm actually going to be looking at something very unique. So a whole lot of new entrants or new investors, new shareholders into Wall Street or the financial markets. Many feedback has been shared with me. What if I don't want to pick individual stocks and I can't actually stomach the ups and downs in the stock market? I just want to still invest in the stock market and still being able to get good returns, but I don't want too much of the volatility, the ups and downs that can be very unpredictable. So for someone like me who has been investing for well over 8 years now on Wall Street, I'm very, very fine with the ups and downs. As a matter of fact, that's where the opportunities are. But for a whole lot of new investors who are fondly called retail investors, many of them actually panic to either sell their stock when the stock is going down or they buy stocks when the market is going up. So at the end of the day, a whole lot of money is being quote and unquote lost because of either over trading, not understanding what they are buying, why they are buying, and when to buy. But there is what we call ETFs, or what is fondly called exchange traded funds. That's the full meaning of ETFs. There's also what we call index funds. So basically, ETFs gives you a better exposure to the stock market, but with less volatility. ETFs, to an extent, are also not immune from the risks in the market. When you invest, you buy an ETF for that matter, you are buying oftentimes a combination of different companies or different stocks put into a basket. So like the index I'll be talking about now today, ETF or index I'll be talking about today, it gives you exposure to the top 500 companies on Wall Street, quoted on the American companies quoted on the US stock market. And the advantage of this is part of what I've just mentioned. They give you a much more balanced exposure into the market. You don't have to pick individual stocks. You don't have to actually do so much research, so much due diligence. Of course, you still have to do your due diligence, but it's not as intense as compared to when you're actually picking an individual stock and you're buying over time, and you have to actually, take on a huge risks or number of risk in the market. So the first ETF which I'll be talking about today, which I've spoken about before, and I actually talk about it from time to time because it actually weighs the temperature of the market. Is the market very optimistic? Is the market a bit bearish? Maybe not too positive, not too or optimistic. Is the market very bearish, which is pessimistic? The market is actually selling off. Or is the market very bullish, or the market is very pessimistic, optimistic, very positive, looking forward to better returns for companies, better revenue, better net income, better earnings per share for companies. So the ETF or the index one I'll be talking about today is the S&P 500. So come with me and let's actually look at this index fund or ETF and why it might actually be a better way to get exposure to the stock market with less volatility, but actually is still exposed to the broader risk of the stock market. So come with me. So this is the S&P 500 index. The S&P 500 index is the most sought after index that actually tracks the Wall Street, which is the US stock market. The S&P 500 is more or less like the bellwether. Um, it actually gauges the temperature of the US economy and vice versa, or by extension, the global economy. So the S&P 500 is actually an index that actually tracks the returns or price appreciation in the stocks of the top 500 companies listed on the US stock market. So it's a very well orchestrated index. It's well vetted. It's very, very prime. Like it's a premium index. Before you can get into this index as a company, you actually have to actually eat different goals, different milestones, if I can use that word, different milestones in terms of the number of the float, which is the total number of your stocks that are available for people to buy, the ownership structure of your company or your stocks, what percentage is being held by big companies who are called institutional investors, what percentage is being held by you and I, everyday investor, which called the retail investor. So also even the corporate governance, also even more importantly, the profitability of the company. So a company, for a company to actually be be listed to or added to this index, you also have to actually at least been profitable for a minimum of close to about 4 or more quarters before you can be eligible. Even when you've actually hit some of these milestones, it doesn't necessarily guarantee that you'll be invited to be listed into the S&P 500 index. Another thing which is very, very key is that companies don't just get added to this index and they are forgotten. No, this index is being vetted over time, tested. A whole lot of companies who don't meet the top major criteria to be in this index are also delisted, and in new companies that are emerging that are actually hitting this goals and milestones are added. So close to about three to four times or two times, depending on what the committee actually does, because it's maintained by Standard and Poor's, which is one of the, if not the most respected, global rating agencies. So this index basically gives you that exposure to the best companies in the market, and these companies are actually held to higher level of scrutiny from time to time. So if you want to actually invest in the stock market, you don't just want to save your money in a bank account, which to some people, that's the only way they believe they can invest to get interest. But if you want to actually get your exposure to the stock market, you don't want too much of volatility, too much of risk, the S&P 500 is actually a better way of investing in the stock market. Now, like I said, it's not immune from the risk of the broader market. If you look at what's going on with the tariff war that President Trump kickstarted a few days ago, you can actually see that the S&P 500 index, just look at my chart. Year to date, the index is now down by with about 1.7%. In the last 1 month, that this index is down by about 2.87% in the last 1 month. In the last 5 days, actually, this index, lost much more, over 3%. But if you look at the last 1 year, despite the very volatile, unpredictable nature of the global economy because of a huge barrage of negative headlines, tariff war from Canada to the US to Mexico to China, this index is still up by about 13%, over 13% in the last 1 year. In the last 5 years, this index is still up by over 88%. An all-time high. This index has really returned record capital or appreciation, if you may, to investors over 128 percent, 128,000%. So because if you are looking at investing in stock market and you actually want to get your risk to be a bit more balanced, to be a bit more weighted to the temperature of the market. Because if you pick a single stock sometimes can even lose close to about 60 to 80% of their value in a day. If there is a very negative headline, there's a very huge scandal, or there is a very remember when CrowdStrike, the cybersecurity company, had a major IT glitch that actually shut down operations of a whole lot of its customers on a single day last year. The stock lost close to about 30% of its value in a single day. It is a bit very difficult for the S&P 500, for instance, to lose over 30% unless we don't actually even want such events. Like even during the COVID pandemic, yes, the index lost a huge part of its value, but it wasn't as just drastic as losing 50%, 30% in a single day. So if you're an investor and you're looking at getting a much more weighted exposure to the market, less volatility, the returns might not be 50, 60, 100%, 200% in a year. You can actually do close to about 10, 15, 20%. As a matter of fact, last year the S&P 500 did about 20 something percent. It's been pared down those gains recently because of all the negative news from the fallout of President Trump trying to start this tariff war to see how he can get better deals for the US. But this is the S&P 500. If you're in the US, just search for VUSA. If you're in the UK, it's VUSA.L or VUSD.L. And depending on which market you are, if you're in Germany, if you're in Australia, if you're in New Zealand or Canada, it's still VUSA for most markets. So just check your brokerage account and you should be able to actually see S&P 500 index, VUSA or VUSD. So that is it for today. Tomorrow I'll be talking about an index fund or ETF that has a bit more volatility, but the returns could actually be a bit more higher. The stock market is actually the higher the risk, the higher the probability of returns. But you also have to manage your risk. So there are some other ETFs that actually tracks a more not necessarily risky, but a more volatile and more high growth oriented market. So I won't let out the name today, but you might have an idea of what it is, but let's keep it to tomorrow. Thank you so much for watching this episode of Soccer Team. If you haven't subscribed to our channel, please subscribe, put on your notification bell so that you don't miss any update. Till tomorrow, when we see again, like I always say, keep investing, keep growing, take care, and bye-bye.